Good morning and welcome to a global morning call. Today is Wednesday, 9th of November, 2016, and we start with this US election special with an update from our strategists at Saxo Bank. We seem to have an issue with our connection with our Chief Investment Officer, so we'll just go ahead with John Hardy and then see if Steen can join us later on. Just, John?
Yeah, thanks, Yasser. Just very briefly to update on the status of the election. The networks seem unwilling to call it, but it seems very clear that Trump is the next president of the United States. If he takes any of, assuming all other states are clear, which I think they more or less are, if he takes any of Michigan, Wisconsin, or Pennsylvania, he will be the next president. It looks to me like he may take all three of those. That's why we've seen the degree of reaction we have seen. Our interpretation of this is that it was very much an interesting miss by all the pollsters, a very loud voice for an anti-establishment feel, and it sets a lot of uncertainty in motion. That's what we're seeing, the initial knee-jerk uncertainty. From an FX perspective and from my own personal perspective, well, let's look at the reaction initially. It was just along the lines that pretty much was consensus. We weren't exactly being creative when we said, okay, if Trump does win, it's not anticipated at all, particularly as the polls started tilting the other way ahead of this. So the reaction, exactly as we expected. Dollar is down versus the safe havens, yen, euro, Swiss, up very much versus the risk-on currencies, especially emerging markets, and among those most certainly against the Mexican peso, which topped out. I think it was 20.7 overnight. It was the highest, back down to 20.3 or so right now. And the question now is, does this move stick? There's no really new news to be wrung out of the actual election results, I don't think. And we could see a sudden reversal. As do we really know what this looks like? What does a Trump presidency mean? I think that's going to take some time to sort out. After all, there are people within his own party that don't actually disavowed him directly and said they would not support him. He's not a traditional Republican. He's a populist candidate, and we need to know. Initial reaction is fair, uncertainty, but we don't really know what this looks like. This is not as if we just had a simple changing of hands party-wise. Calendar today, I won't spend much time on that, but we do have the RBNZ tonight and CPI from Norway later. On the FX side of things, things I'm looking at, I think dollar yen is mispriced already. Certainly in the longer term, there's nothing that's changed the fundamentals of what the Bank of Japan is doing. I have a price versus rates in a moment, and I'll show you. I think the Mexican peso may have overreacted relative to its EM peers. And what is the broader lesson we were to draw? People were trying to draw the lesson of Brexit, the anti-establishment vote there, to the Trump election. That seemed to be faltering, but now we have it sort of confirmed with Trump's victory. What is the next anti-establishment vote or process potentially taking place? Could that be in Europe? Could that be with the December 4th referendum in Italy? And that's an interesting question, I think, as we head into that December 4th vote, and that could be a story that picks up in the weeks and months to come. The only thing I think that is most certain here is Trump has spoken very directly against Yellen, who represents the establishment that has helped, the vote against which helped him get elected. The clock is ticking on her time as Fed chair. Her term runs out in February of 2018. Now, very briefly, I think we have Steen back on the line, but just a reminder, if he takes any of Wisconsin, Michigan, or Pennsylvania, the vote is already his. I think the markets have already drawn the conclusion, so I don't think there's a whole lot of anticipation left around that. Dollar yen, I just want to show the mispricing again. We have this tremendous reaction to dollar yen. U.S. rates have been a bit slower to react. If we have these U.S. rates going higher, it feeds straight into the spread against Japan, where the Bank of Japan is fixing rates. Steen, are you there? Would you like to add to any comments there?
Sure. Can you hear me, John?
Yeah, I can. If there's any way you can turn up your volume, I think I'm suspecting it's a bit low for other people as well.
I will try to turn it up or speak louder. Good morning, everyone. I'm sorry for the delay. I guess I'm in the one country which is not surprised about the election, because apparently, according to mainstream media, the Russians has already hacked this election. I'm in Moscow, so sorry for that line. I think, as we talked about all year, this is dramatically not about Trump actually winning. First of all, it is Clinton losing again. Don't forget, 8 years ago, she lost the Democratic vote to Obama, despite being further ahead than she was against Trump. So if it's not about Clinton, if it's not about Trump, what is it about? It is about the social change. This is the 1989 Berlin Wall generation coming of age. They grew up with globalization and trade. This is the anti-trade, anti-globalization, similar to my generation's parents being anti-war because they grew up in World War II. So to a large extent, if you want to focus on Trump winning and getting negative on that, be my guest. But what it's really about is like the Brexit, as John was referring to. It was about the fact that the middle America, the low-income America, did not see any change. Most American actually thinks that U.S. is in a recession, despite, of course, normally having 2% growth. So this is what I call the movement of the clock against the normality. So in other words, this is the pendulum swing that goes to the far right in terms of the US in this case, but it's not really a proper far right. It's really only about the change, the mandate for change. People could not live with another 8 years or 4 years of Clinton doing absolutely nothing except kicking the can down the road. That does not mean that I embrace any of what Trump says. Actually, I think the solution to the world's problem is more trade, less borders, and of course more globalization in the sense that we need to be smarter at what we do. But the first move, and the move we have to embrace, is the fact that the popular vote in America decided to vote for Trump. This is the highest office in the world. It represents the pinnacle of political power. So to a large extent, as John was addressing, this is a sea change in the world of politics. It will ensue also major changes to policy. I think Bank of Japan led the way in terms of backing down from spending enormous amount of infinite money to lower interest rate. And instead what we will see is a more targeted final attempt to macro management. We will see Trump come in with a corporate tax cut. He will repatriate money, probably instituting a levy on the inflow that comes in, using that levy, the tax revenue, to use for infrastructure. He ran on the platform Make America Great Again. If there's one thing the Americans like, it is the sentiment of being great. I think to a large extent the market will be nervous. I think middle America is not too worried about the new Trump presidency. In terms of the marketplace, I'm totally with John. I think first of all this will be a move towards Fed not moving. I think it's very important to point out the Fed ahead of this election had a 70 to 80% likelihood of hiking rates in December, and this now is 40% offered. I think the dollar will be weaker initially but stronger. But I think the big thing that can actually move over time, and Michael can probably talk about this, is fixed income. Right now there's a relief or whatever way you safe haven rally in yield. In other words, bonds are going up. I think ultimately the price of money in the U.S. will continue to go up. It will drag the dollar stronger ultimately. But first we see this nervousness. So,
thank you, Steen. There we are. So where are we? We're going to see a replay of Brexit in markets. I think that's very likely. I'll come back to that in a few seconds. The grey market on DAX, since I made those slides here, have come down a little bit, 40 points more. So we're just shy of above 10,000. I think it's very likely that we sort of open there unless we escalate further towards the futures open. But I don't think it can hold the line. I think there will be so many stops that will be triggered when the DAX futures open that I think we could be pushed below that 10,000 level. If you look across the Asia region, you can see that's a table here. You can see the breakdown on sector level. So we are down around 3.4% in Asia, developed markets, led by all the cyclicals. It's not a huge surprise. I think the big surprise is, that financials has actually kept the line hold up pretty well, I would say. Gold, obviously, we have to watch the gold miners. I think it's a replay of Brexit. We'll know Randgold Resources and the gold miners on the London Exchange will pop on the open and could actually extend short-term momentum. Will likely be strong. Pesos obviously is feeding into Mexican stocks. Look out for the ADRs and ETFs when the US stock market opens later today. So potential reaction function. So in the DAX or in the CFD index tracker and the Saxo platform, we could likely see the first gap down and print just above 10,000, and then I think the stocks will be triggered, and I don't think we can hold that line. But if we go further down, I think if we could go all the way down to 9,800 if it gets ugly, and I think that would be definitely a buying opportunity area. Also, I just want to highlight here that we have now a close in the Nikkei futures. It closed at minus 5.5%. And against the euro dollar print I have here, it's actually only up 2% now versus 2.4 here. I think also it's quite interesting to see that the core in China, so the A50, that is the largest 50 companies, not trading offshore. They do have an offshore stock here in Hansen, but most of them here, the A50 is onshore. It's actually holding up pretty well as well. Talking about the U.S. equity market, I think we have a pretty firm idea of where we are in terms of levels. I think it's much more difficult to come with exact levels on the DAX, but I think it's pretty clear that we may are looking at an overreaction to Trump. We have all these stuff, as I said. I think it's a Brexit replay. I think, as John alluded to with Yellen, I think maybe also the December hike is off the table, as even though they don't think that, even though they say the Fed that they don't are engaged in politics. And actually, I think over time, at least intraday, I think people will realize that maybe it's not a big deal that we have Trump. So I think buying here at in the S&P 500 is worthwhile. I think the risk-reward ratio could be good intraday. Our stop is at 2020 and the target is 2080. Obviously, the holding period is short-term, and I think the much broader point here, as John said, we don't really know exactly how this is going to pan out. But I don't think it's all negative for equities as we go into 2017. If he could cut the corporate tax rate from 35 on the marginal tax rate down to 15, it will make a huge boost to investment sentiment and also earnings per share. So I think that could be a tailwind of support for equities in a Trump administration. I've talked enough. I'll give the word to Ole on commodities. Thank you.
Thank you, Peter. Mixed reaction in commodities as we can expect. We got the growth-dependent commodities such as oil and copper trading lower, while safe haven demand has resurfaced in gold. So what's Trump's views on gold? Well, what we know that he is opposed to free trade, and that could obviously slow the risk slowing global growth and thereby also slowing demands for some of these key commodities. That's probably the initial reaction to oil we're seeing this morning, despite the weakness coming from in the dollar, which should add some support. To contrast, he's pro-fossil fuel, which could result in policies that could see U.S. production recover quicker. But at the same time, he's also been calling for reintroduction of sanctions against Iran, one positive, one negative. So a lot of things to digest in that market over the coming weeks. But obviously the initial reaction is to sell the market lower, also because the market remains long. Even though we have seen quite a lot of long liquidation over the past couple of weeks, the market has remained long. So that's the direction where the market was easiest to push at this stage. Gold has seen some safe haven demand, but also if you look at the outside markets, already mentioned, this is probably taking the risk of a rate hike in December off the table, the risk of slowing growth and potential at the same time rising inflation, and the weaker dollar that we have seen now as an initial move is all playing into the hands of gold. But looking at the chart today, we broke above the trend line from the July highs. We're back down below, currently trading 1322. We need to close above 1330 today. If we do that, then I think that could be quite a strong signal that we could see a move back towards the 1375 area, and that really will be the key now, because that is the multi-year trend line coming from the highs back in 2011. So a break above that 1375 could signal another $100 to the upside. So still early days, but we've seen a big surge in volume. That's natural on such an event. But from a more short-term perspective, deeper into the week, we need to close above 1330 today. And I'll just, before I pass you over to Michael on bonds, I'll just give you a quick heads up on some of the movements we've seen overnight. Mentioned already, Mexican dollar up strongly against the Mexican peso. Just reminder, limit downs on S&P is 2,028.5. Limit down on that's the VIX. Sorry, that should have been the Nasdaq. That is 4,558.5. These will be, if the goes limit down, these limits will be extended when the market opens this afternoon. That's it for me. I'll pass you over.
Thank you, Ole. Fixed income markets, bond markets also reacting to this surprise win, kind of an expected manner here, short-term safe haven bid. U.S. Treasuries is the only instrument which is actually trading right now in bond markets. We have the 10-year note at 130. That's 1 full point higher. You can see the chart right here. It was at 131 earlier. and we were seeing calls for bunds to open at 164 or even higher. That would be more than 2 points higher, and it would take the German 10-year yield back into negative. It closed at almost 20 basis points last night, so quite a huge move that would be. But given the drop here in the Treasury, I think that's probably or less likely. So the reaction so far a little bit less significant than what we saw during Brexit, but obviously still yields dropping very fast right here. And as was mentioned in terms of Fed and future policy, that's obviously the big question right now. The December hike chance has been reported below 40%. It was at 82% last night. We have to keep in mind this is very early trading. It's very thin and volatile trading. But I would agree with the earlier speakers as well. I would put this at a lower chance. It's just very difficult to see Janet Yellen hiking into this turmoil that we're likely to see, with her own job at the line as well, possibly too. And the uncertainty is just huge at this point. Longer term, though, there is a case that could be made for higher interest rates during this Trump area. First of all, he's been very outspoken against Janet Yellen. So as Steen said, we definitely expect her to be gone by 2018, if not earlier. Question is if she'll be replaced with a more hawkish profile, and what happens if the economy slows down because of rate hikes. Is this something that Trump would assume responsibility for? So I think that's still going to keep a lid on interest rates in the longer term. In the shorter term for emerging markets, if we should see some relief here because of the softened rate hike pressure. Obviously, Mexico and China gonna see some pressure on the beneficiary side. We might find Russia. Trump has been notably softer on Russia, and where does this possibly leave the sanctions? Could we see a relief there? That would definitely be good news, and I think it's worth noting in that regard that the Russian ruble is only marginally lower in early trading compared to other emerging market currencies, which are far worse off so far. But I will leave it here. 10 minutes to European cash markets open, so we'll see where it all opens up. I wish you a safe trading moving forward. Back to Yasa.
Thank you, Michael, and thank you all for joining us. Please go to tradingfloor.com, where you can see an updated information and analysis from our strategists. Have a very nice trading day.